Now that you've got that covered, let's dive into today's topic. Do you really know the difference between currency value and exchange rate? A lot of people think they mean the same thing, but trust me, they're not interchangeable. In this video, we're going to go deep into what these two terms actually mean, and why understanding the distinction between them is so crucial, especially if you're looking to navigate the world of money, investment, or currency trading, particularly when it comes to the Iraqi dinar. But why does this matter? Well, the answer is simple. Understanding currency value versus exchange rates helps you make more informed decisions when it comes to managing your finances. The world of currency is influenced by various factors, especially economic policies, and these decisions shape the future of our money and our purchasing power. That's why it's so important to have a good understanding of what these concepts mean and how they affect the economy. Let's break it down. First, let's clarify what we mean by currency value. Currency value refers to the real, intrinsic worth of the currency. This value is influenced primarily by the economic and monetary policies set by the country's central bank, in this case, the Central Bank of Iraq, CBI. The currency value can rise and fall based on a number of factors. For example, if the government of Iraq decides to increase interest rates, this can have a positive effect on the value of the dinar. Higher interest rates tend to attract foreign investors looking for higher returns, which in turn boosts the demand for the currency, making it more valuable. The idea is that a stronger economy, or at least one perceived as stable, will make a currency more valuable to investors and traders alike. But there's more to currency value than just interest rates. The government may also implement fiscal policies, address inflation, and adjust fiscal strategies to influence the value of the dinar. Over time, as the government's policies succeed in stabilizing or improving the economy, the value of the currency may strengthen. Now let's move on to exchange rate. This one is a bit simpler. It's the rate at which one currency is exchanged for another. The exchange rate tells you how much of one currency you can get in exchange for a unit of another currency. For example, if the exchange rate for the Iraqi dinar is 1,400 dinars for $1, that means it takes 1,400 dinars to equal $1. But here's the key point. Changing the exchange rate doesn't automatically change the currency's value. The exchange rate is a reflection of how much a currency is worth in relation to another currency. However, changing the exchange rate by itself doesn't directly affect the fundamental strength of the currency itself. So, while the exchange rate might fluctuate based on supply and demand, it doesn't necessarily represent a genuine change in the value of the currency. Why is it so important to understand the difference between these two? Well, it's all about how changes in the economy affect your money. When we talk about inflation, currency devaluation, or the policies that affect the value of a currency, understanding the difference between value and exchange rate helps you recognize what's really happening with your money. In the case of Iraq, the government has been actively addressing economic issues such as inflation, currency instability, and low foreign investment. They've put measures in place to improve both the value of the dinar and the overall economic environment. These policies include measures like raising interest rates, introducing new monetary tools, and phasing out inflationary currency notes. It's these types of changes that help improve the actual value of the dinar, which eventually impacts its exchange rate as well. One of the more recent discussions around the Iraqi dinar has been the plan to remove the inflationary zeros from the currency. What does this mean? Well, due to years of inflation, the Iraqi currency has developed large denominations so large that they've become less practical for day-to-day transactions. For example, if you're carrying around 25,000 dinars just to buy some basic items, that's not exactly convenient, right? To address this, the government plans to remove these high-denomination notes and issue new ones with lower denominations. Instead of carrying stacks of cash, people would be able to handle smaller, more practical bills that reflect the true value of the dinar in today's economy. But there's a catch. It's not a quick or easy process. In fact, this change won't happen overnight. It requires careful planning and gradual implementation. The government needs to ensure that the new, lower denomination notes are supported by solid economic policies and that the value of the dinar has stabilized. Once the inflationary zero notes are removed, there is hope that it will help stabilize the currency and restore confidence among both local citizens and international investors. Now, this is where it gets interesting. When the government removes the inflationary zeros, you can expect to see a shift in the exchange rate as well. But let me make one thing clear. It's not just about removing zeros from the currency. The exchange rate will only improve if the true value of the currency improves first. In other words, it's about economic policies that actually strengthen the dinar's value. Only then will the exchange rate reflect this improvement. To help explain this, think about this analogy. Imagine you have two friends selling apples. One is selling apples at a reasonable price, while the other is trying to sell overpriced apples, and no one wants to buy them. But the first friend improves the quality of their apples and makes adjustments to the price. As a result, more people buy from them, and eventually they can sell their apples for a higher price. In this example, the apple's value increased because of better practices, not just because they changed the price tag. The same applies to currency. If the government carries out successful economic policies, the dinar's value will rise, and over time that will be reflected in its exchange rate. As you can see, the real growth in currency comes not from cosmetic changes like removing zeros, but from sound monetary policies that foster a stable economy. For currency to grow in value, it needs to be supported by sustainable economic practices. This is essential for rebuilding trust, both among citizens and foreign investors. When people trust a currency, that trust brings stability, which in turn leads to economic sustainability and growth. Now that we've unpacked this, what can you do about it? Simply put, staying informed is key. Understanding the difference between currency value and exchange rate helps you make smarter decisions about your money. If you're considering investing in currency, or if you're already invested, this knowledge will help guide you through the ups and downs of the market. Additionally, keep an eye on news updates regarding Iraq's economy, particularly from the Central Bank of Iraq. Following these updates will give you insight into how these policies are unfolding and how they might impact the dinar's value over time. Knowledge is power, and staying informed will help you make better financial decisions in the long run. Before we wrap up, let's touch again on the idea of removing zeros. Imagine you have 1,310 units of currency. If the government removes the zeros, it becomes 13.1 units. That might look simpler, right? But here's the thing. Removing the zeros doesn't change the value. If you still only get $0.76 for 1,310 units, then the value hasn't improved. It's just a cosmetic change. Essentially, we're just making the numbers look nicer without addressing the real value of the currency. Let's break this down with an example. Suppose a small shop sells a loaf of bread for 1,310 units. If the government removes the zeros, that same loaf of bread would cost 13.1 units. Customers might think they're saving money, but in reality, they're still spending the same amount to buy the same loaf of bread. The value of their purchasing power hasn't changed. Some might argue that smaller denominations help by making things easier, but it's not that simple. Splitting a dollar into smaller pieces doesn't increase its value. It just creates more confusion, especially during everyday transactions. The value of money is rooted in real economic changes, not just in how it's packaged or how many zeros are attached to it. There's a reason that removing zeros has been tried before in other countries with little success. Take Zimbabwe, for example. In the 2000s, they removed zeros from their currency repeatedly, but the value continued to decrease. In fact, the value of the currency plummeted to the point that even US dollars became more desirable than their own currency. This is a clear example of how changing the format of the currency without addressing the underlying economic issues doesn't solve anything. So what can we do? As everyday citizens, the best thing we can do is stay informed. Understand what's really happening with the currency and economy, and don't get distracted by superficial changes. When you hear about news like this, question it, discuss it with others, and share your insights. Knowledge is power when it comes to finance. Understanding the differences between currency value and exchange rates gives you the tools you need to navigate the financial world confidently. Thank you so much for watching. If you found this information helpful, don't forget to like, share, and leave your thoughts in the comments below. What do you think about the upcoming changes to the Iraqi dinar? I'd love to hear your thoughts. Stay informed, stay engaged, and I'll see you in the next video.